Our problem for today and until the second assignment will be to talk about exchange rates. Unfortunately, last week I was talking way too much and it was still some topic to talk about or to have discussion about it, but now because time is ticking, we have to focus on other issues, and these other issues are the exchange rate risks. So if you are looking here on the financial chart on the Reuters or now Econ database, we can see what is happening between the euro and the US dollars during the last 20 years. And okay, usually I'm saying that, oh, the euro US dollar exchange rate is behaving like a sinus curve. It's not that sinus-ish if you are looking on it, so maybe if you are not looking on daily data but we are jumping to annual expression, and let's use maximum, then we can see that sometimes it goes up, sometimes the US dollar appreciates a lot, like here in the last time in the 80s and also in 2000 and maybe in 2015. So once in a decade the US dollar has an appreciating phase, otherwise mostly the euro, or obviously before this time period it was the ECU which was stronger, at least in value on the exchanges. Bless you. So we can see dramatic fluctuations. So it's not like Hungarian forint or other emerging currencies where you can find huge volatilities, where you can find appreciation, depreciation on the long run. So if we would add HUF US dollar, we can see some trends here. So in this case we can see a clear depreciating trend. Okay, this is what happens, but in the case of US dollar euro rate we cannot see this, so it fluctuates at most between 1.4 and 0.9. So that's all the margin for volatility, and today I would like to start to analyze this exchange rate, so how it behaves. Since last week I was talking about so many different anomalies on altogether capital markets, and that's why I talked about anomalies on stock prices as well. But let's see currency markets, how crazy they are. Or are they more than other markets supposed to be? So okay, let's drop the idea to analyze for it, because okay, it will be crazy enough. So we can see that it's that's why you have to introduce euro. So let's see. Now we have different currency pairs, and no, we are not using. Let's use weekly data because it's easier. We don't have missing data because of different national holidays and issues with that. So, oh, we are operating in France, so French government bonds, benchmarks, and also for the US. It will be good for us later on when I have to show you how to deal with option pricing, and I don't want to download everything again, so it's better to do it right now. Now it's good. Let's copy it to the MATLAB folder, and now we have something to work with. Okay, so first question would be, are these markets efficient or not? So let's create a nice, that the change of the exchange rate, and there is the delta, in time t, oh, sorry, it's price, t will be equal, we can have some constant, but usually we don't want to have this drift, so let's not include it. It just creates problems. just have a beta. This multiplies the previous value of the exchange rate, and then we can have some noise, or shocks are coming from here. So the data generating process can be something like this, and this is when the price remembers its previous value. And obviously the problem starts when we don't have just a memory for the last trading occasion, so last week for our weekly data set, but if it remembers the previous weeks and so on. So we can say that anomaly 1, that plus 2 plus 1 point. It's not I, it's VBQ. Is identified. Hey, it's quite common. I think that last week I also mentioned that in stock markets you can find time periods when or at least we were able to find periods when the Dow Jones Industrial Index was remembering for the last 30 days of trading information, so it happens. And this is called autocorrelation. If you find an autocorrelation on a market, then after that it loses even its weak efficiency. So it's quite serious trouble. Second thing, okay, now we are outside. So prices should change randomly. So this is the shock or innovation. So this random change would mean that it's generated by a normal distribution. So it's like a white noise. It's the same thing, just. So mostly what happens is around the expected value and not so much extremes are happening, so it's quite boring. Okay, in this market we don't have deep recessions and global financial crisis situations, so it's boring can be a good thing, but yeah, so anomaly second the crisis, sudden depreciations, so currency exchange movements, etc. So mostly we can find kurtosis, so force moments of the standard deviation is way bigger than 3, what is supposed to be. So yeah, it's fat-tailed distribution. So the tails of the distribution are the two low probable and high change part of the distribution, and this is called fat-tailed because it has way more data there than it's supposed to be, so that's why it got its name. Evaluating efficiency on foreign exchange markets, and then we can we have to load in the data, so we have a chance to see. So data equals, it's always left side of the equation is the output. There is an equation mark, then there is the function name. Let's read. You don't have to read it at home, just I show you that if you want to do any kind of mostly all the script languages are the same or quite similar, so it doesn't matter that which one do you want to use, but what is the name of this weekly currency? Cool. So we are reading in the data, hopefully there is not so much, or is none. Just I'm checking, the is none function looks for missing data, and before I can see that, okay, there are problems, there are no problems, cool, then we can have the logarithmic differential. The logarithmic differential is actually what we are referring always to return, or S returns. So we have to see that what is the difference between each week's prices, but alone this would create different scales, because some currencies are fluctuating, like the euro US dollar fluctuates around or between 0.9 and 1.5, but other currencies like, let's say, zloty, it fluctuates somewhere around, I have no idea, but it has 2 digits at least. No, it's still 1 digit, but the Indian rupee, it has 2 digits. So to remove this scaling issue, or in the case of Japanese yen, US dollar, we have 3 digits. To remove this problem, it's much easier to say that, okay, let's use logarithm on the data set. And in this case, we can say that, okay, ret equals diff log. So first we will do the logarithm on the data, and then we will see funny things, because we are doing logarithm on yeah, it's not visible yet, now it is. So I included in the last 2 columns 2 interest rates, and obviously once the interest rates are starting to become negative because of crisis management, so once I will talk about interest rates, then we can see that there was a negative period, and obviously you cannot take its logarithm. But today we are also analyzing currencies, so we can say that, oh, I don't care about currencies at all, so let's select all rows, and 1 till, okay, how many columns did we have? 6, so 6 currencies are in our menu. The rest will be not selected. Let's delete this one. So you have to be really careful how to use. So if you are working with any kind of interest rates, then logarithm is not an option. In this case, you can use z-score or standardization, or you can just divide it by 100 and you can still rescale the data, but otherwise that would be misleading. Okay. Just I'm thinking that, do I want... one more thing, that we have this fancy application called Distribution Fitter. I used it last week, but since we have it, okay, create data set. Okay, I would like to have a fit all together. Just right now MATLAB is not cooperating as fast as... Actually, MATLAB is quite a durable software, so this week I was running out of computer space because all these videos are filled up my SSD, and it was still running when I had only 100 megabytes of free disk space, so it was not warning me at all. Just once I was recording a video and it said that now we are running out of this space, and it was not able to work anymore. So we have this ugliness here, and these are all different currencies fitted on the top of each other. And here is what we can see, that it's already hard to say that these currencies are behaving at the same way, because come on, there is this blue one. I don't know which one because there are two blue ones. Maybe this the Indian rupiah is responsible for this, but we can see that they have completely different probability distributions. So they are. We have really huge there, so we can say that even here we have some data. It's quite invisible, just we can see that the line is green, so at least there is one data point with a really serious jump back and forth. Also here we can see something, also there is black, so it's all the third currency is there, so we cannot say that each currencies are the same. At least are they normal distributed or not? So let's see the classical US dollar euro exchange rate. Are you at least normal distributed? And no, it isn't. Well, if you are lucky and you cut out in a specific way the sample, sometimes I was able to get it. So I was downloading some data for students, and somehow I was able to create normal distributed US dollar euro exchange rates, because maybe one extreme day was missing or year was missing, which contained a crisis situation. But anyway, we can see that even this highly liquid market has some I can use this. So there are some outliers, and okay, we can see that in the case of the expected value, mostly this currency pair is not doing anything at all, so it fluctuates around zero, but it has also its own crisis periods. And this is the best behaving currency pair that you can find on the planet. But it's still funny that if we are comparing it, or all these currencies in the sample right now, we would compare it to share prices, we would compare it to interest rates, for example. Their statistical behavior are still much closer to the efficiency hypothesis than the other markets or other products. So still we can say that, or at least many people are saying that, times were much better under Bretton Woods system when every currency was fixed against each other with this narrow 1% of fluctuation band or 2.25 fluctuation band. And since then, this free-floating nonsense is happening since 1979 in many countries, but it behaves much better, still behaves much better than stock markets or the overly managed interest rate markets. So it's okay, I removed it. It's funny from this point of view, but let's see some deep statistical analysis just first of all I will copy this one because it looks nice. So you have to make some notes that these changes are not supposed to happen. Were. I think that when these changes happen, then some or one or two mutual funds or hedge funds had a bad day. So okay, but why I'm open MATLAB is the reason that I'm way too lazy to do these manual calculations, because we could do this in eViews or in Gratters or other graphical softwares, maybe also in SPSS, but SPSS is for people in marketing, so not doing this class because we are doing finance. So what can I do if I'm lazy and I don't want to do manual labor? Maybe only once, because if I'm writing a for cycle, which means that I'm asking the script that please check the first column of the data, second column of the data, and so on. So all 6 columns of the data, so this J variable can be everything. And please analyze the mean, the standard deviation, the asymmetry, so the skewness of the data, the kurtosis of the data. Oops. Yeah. Please check the normal distribution, because there is this GARCH test. I know that on statistics you learned Kolmogorov-Smirnov tests, I think, to test normal distribution, but for time series people are using GARCH. So if you are opening articles, it's always GARCH test. They are consistent on the other hand, so yeah, but this is the custom. For autocorrelation we have this Jungbox test, and this one have to be under 0.05 to have autocorrelation here. And there is heteroscedasticity. Students are like this, so if there is activity or something like this, then heteroscedasticity sooner or later arrives. So it means that sometimes there are periods when volatility is high, sometimes there are periods when volatility is low, and we will see that what happens. Also, there is stationarity, which means that time is not affecting, so the passing of time is not affecting the mean and the standard deviation of the data. So it's not like temperature, that if we are looking on the clock and looking at the temperature, sooner or later temperature increases because sun rises and it puts heat in the sample. In finance we don't have this, so if we have some differentiation on the data, then it will be operating as a stationary data. It's necessary because you cannot run any kind of regressions on non-stationary data, because it will be completely biased, and that's why we have this automated script, because it will create a nice output for us and we don't have to do any manual labor with that one. Yeah, we have some warning signs, but it's okay. So now we can just copy. Okay, this one means supposed to be around 0. We can see that they are around 0, so at least something is working here. Standard deviation, here we don't have target date. So you can remember on corporate finance lecture that if something has a higher standard deviation, it's more riskier. Polish zloty has higher standard deviation, so maybe we can highlight it that it's anomalous. In the case of Chinese renminbi, this really low standard deviation means that the Chinese renminbi follows a fixed exchange rate regime. All the rest of the currencies are free floating, so that's the reason that it's In the past it was fixed to US dollar. Nowadays it follows some kind of currency basket containing euro, British pounds, US dollar, and so on. So that's the reason that the standard deviation is low here. So yes, it's an emerging. Still considered as an emerging currency. So and still we can say that one specialty here, because that's why we added it. This one is a safe haven currency. So safe haven currencies are always, or safe haven assets are always appreciating and increasing their value if there is an increasing uncertainty of the market. So that's why they are special. So it's safe haven assets like gold or Swiss franc or sometimes Norwegian or Danish krona have similar behavior. So you need macro stability, really low public debt levels, low inflation, and sometimes even we can see that Czech krona also behaves like this. So maybe it's up to the kronas and francs to have this thing, but yeah, we can see it in the skewness. So if the data set or the currency is fluctuating like a sinus curve, so it goes sometimes up, it's going down, then it will be completely symmetric. But if you have some tendencies, higher tendencies towards appreciation or depreciation, we can see that it will be much more asymmetric. And here we can see that there is a tendency for appreciation here, here, and especially here in the Swiss franc. So if we are looking on the data, oh, we have to scale this up. So this way is where appreciation happens, and we can see that this was quite a dramatic issue for the Swiss currency and also Swiss companies, because if you are exporting something to the US or Eurozone, or so you are exporting, then you have to be able to compensate all these changes in the exchange rates, otherwise you are losing your competitiveness. So this is a great pressure on them to increase productivity and to manage somehow to survive. So many Swiss exporting companies started to open branches and subsidiaries everywhere in Europe, like Stadler Trains, which opened factory in Hungary, in Poland, in Belarus, and elsewhere to make components for their vehicles to reduce costs and exposure in Swiss franc. Yeah, so we can see that this is highly anomalous. So until you are really close to zero, then it's not a big deal. But if you are moving away, so in the case of Polish zloty, we can see the opposite. So it has higher tendency towards depreciation. In the case of Chinese renminbi, I think that we can see any possible directions. So yeah, so it had a floating, it had a absolutely fixed period. Then there was a period of time when it was allowed to appreciate. Let's say it's 6. Yeah. So that was appreciating until 2008. Then it was fixed again. Then it was allowed to appreciate again. and since the mid 2010s we can see it starts to follow quite different trend lines, but yeah. So this is what creates here this kind of anomaly, because otherwise it's not depreciating. It's, if you are looking on the long-term trend, then it's highly in an appreciating phase compared to the early 90s, so, or the late 90s, sorry. So it's quite a question mark. Okay, kurtosis. So this refers on the extreme values, and if we are looking on it, we can see that yeah, this is supposed to be 3 to have an efficient market, and 4-ish. It's still something. Okay, in the case of Swiss franc, because it's, I will show you that this currency is completely crazy. So that was this one, yeah, the green one. Which fits, remove it, new fit. So even we can find it here and there, and also some anomalous changes were also happening here. The reason is that they are artificially created, because back in the day, in 2011, in September, the Swiss National Bank announced that now they would like to stop the further appreciation of the Swiss franc, so they introduced a 1.2 euro cap against the appreciation. So under this cap, it was able to fluctuate freely, but it was not allowed to go forward. And this is what happened here. When the cap was introduced, then on a funny day in 2015, in January, they abandoned it suddenly. And I don't know what they were expecting, but the exchange rate exploded, so it appreciated way further. So maybe the idea was not that great as they were considering at the beginning, because the communication was that now we are removing this barrier because the market had a time to adapt to it, 4 years. So yeah. So that's why we can say that yeah, this exchange rate is quite, or literally, behaving in a crazy way. But we should highlight everything as, at least with an orange color and with different oranges. So we can say that okay, they have also some issues. We were able to detect that it's not fitting to normal distribution, but yeah, they are on a quite different scale of craziness. Okay, this is absolutely not good. So we already have this not normal distributed. And which is funny that this data has no memory here. They have. So still we can see that they are close-ish to market efficiency. But if we are looking on heteroscedasticity, this is not the case, because we can see that. They are affected highly by market mood, so there are periods high and low pricing confidence. So let me show you that what I'm thinking about. So if I'm looking on the logarithmic changes, we can see that for example, there is this time period with quite low volatility, then some shock comes, and then volatility increases, so it fluctuates way more, then later it calms down. So this is heteroscedasticity when we can see that, yeah, it's absolutely timely related variable. And now let's see another phenomenon. Because we already have this homoscedasticity, and later on when we were dealing with options, so when we are reaching the micro level, reaching the level of the company, because right now still we are on macro finance level, but it will be relevant for us when we have to price in option. Option pricing is always dependent on two things. One is interest rates, interest rate differential between the two currency, and volatility of the currency. So that's why we have to talk about volatility here, because yeah. Okay, we could say that, oh, volatility, come on, we calculated the standard deviation of the data, so this should supposed to be enough. Just the problem is that if we have this homoscedasticity, it means that the standard deviation, it changes in time. So option prices, option fees will be completely different from year to year, or especially from week to week, if this is the case. So that's why we have to second point. Yeah, this was the first point of basic statistics. Second is conditional volatility. In the case of conditional volatility, we could see or we could use model selection. So there are really disgusting models. I have a really good model fitter when you can define many or compare different models, because people are using different GARCH models, but now we don't do this today. So let's see just an old-fashioned DCC-GARCH model, what we were able to see last week during the presentation, and we don't need all this stuff. No, we don't need them. I wrote that torch type. Okay, we need that, but this one not. Some components are optional to include, so that's why I'm deleting them happily. We need the return here, and we have to define the variables EOQ. So conditional volatility models are defining that there is standard deviation can be estimated for each days, or in this case for each trading weeks, and we can see that how long do we want to go back in time to include past data into this equation. So we are always using 1. So 1 week old shock appears in the volatility. This O parameter is that sometimes volatility happens if the currency depreciates. Usually this is the case, except the Swiss franc, when volatility increases when it appreciates, because it's Swiss franc. So asymmetry. Depreciates up or depreciates. And there is this Q variable, so 1 week old volatility matters, which means that if the market was not able to price in well the currency, it will be not able to price in well also this week. So that's why we have to talk about this. Error type, we can have different error parameters. Start type will be 2, I don't want to discuss this. But in the case of error terms, we can have fancy normal distribution, student distribution. Let's have student distribution with skewness. So in this case, we are able to add all the anomalies coming from the data set, and also we should analyze or collect this data for each currency. So we are again building a for cycle. We will ask the script to run it for 1 till 6. And what? Oh, sorry. Okay. Just I have to parameterize that the return is also a vector, not a matrix. Because, yeah. And it's not running because something is dead. Cool. Sometimes skewness is not preferred. Yeah. Exchange rate fifths. Which one is the fifths? 1, 2, 3, 4, 5. Ah. Chinese renminbi is not happy. Okay, let's remove. Yeah, okay, parameters must be deleted. And then I can run again. Now it's running. Okay. Yes, now, okay. So this is the shock. This is generated by the market, unfortunately, randomly. And this is the importance of past volatility. So we can see that mostly volatility in the data set in this week is highly affected what happened last week, because all these weights are above 70%. So if the market is uncertain, then it's really hard to make it certain about pricing. So that's why central banks have to be quite aggressive when we have to change or increase interest rates, when they are able to see that suddenly there are sudden depreciations. Then there is an immediate shock in the case of interest rates, because monetary policy is struggling or to do something. This is what we can see nowadays. When still we are able to see, even before the current Ukrainian case, we are able to see that already COVID and before COVID, inflation started to increase, and everybody was expecting the central banks to do something with their interest rates to fight against inflation, because this is where their primary objective, at least in the European Union and in the US by law, so they have to do this. And since they are not doing this so much, then it creates shocks and surprises on the market. So this is when shocks are happening. So the third currency, which is Swiss franc. determined way more by shocks than the others. It's also funny that this is the Chinese renminbi. Okay. I would expect the opposite combination, but this is the model fitting. So, at the end of the day, what do we do here? Because yes, it's nice to have parameters, but this is not the goal. The goal is to have the conditional standard deviation, which is the square root of the conditional variance, because conditional variance was this HT which was provided by the model, and if we are plotting them out, we can see that they are nice. So on this 20 years of time frame, we can see that, yeah, there were periods when the market was absolutely unsure how to price in several currencies. So this is when volatility explodes, but you can see just it's for some weeks. So sooner or later something happens, because that's why we have central banks and monetary policy. And also there are calmer periods when usually nothing is happening, business as usual, we can price in currencies, also we can see it at this time period as well, so it's not always crazy, just sometimes, yes, it is. In the previous data, green was always Swiss franc. I'm not sure about this case, because maybe this is a fitting error, sometimes it has it. So let's import this data to our Excel sheet. No, this will be the Chinese renminbi, okay. For the Chinese renminbi, it's not a surprise that it has smooth volatility, because come on, it's a fixed currency, so this is what they're supposed to do. Okay, we have to delete the first, because the differentiation removed one data. And then we can see it in its view. Okay, thank you, Excel. So we can see it in its whole body or beauty, just I have to add dates, because right now it's not able to realize that it's so. Yes. So we can see that, okay, if you are using a fixed exchange rate system, then the volatility will be really smooth. So, and in this case, we could say that, well, then, if the volatility of the exchange rate will be smooth, then why are we not using this? Because the reason is that there is a trade-off. So on one hand, you can fix the exchange rate, but all other macro variables will have higher volatility. Or you are saying that, okay, let the currency behave this way, and we are using floating exchange rate. But in this case, the monetary policy can smooth out the volatility in the output, in the inflation. At least according to the statistics, we can say that also in the interest rates. Okay. So yeah. And this is what we can see here, that okay, some countries, so if you are looking on the data, we can see half of the countries on the planet are focusing on fixed exchange rate systems, so they are on this side of the trade-off, and other half of the countries on the globe, they are focusing on using floating interest rate or exchange rate. So we can say that it's up to the entire underlying economic model, political background, and so on, to define that which one you will choose. And this is the abandonment of the cap in Swiss franc. This is the introduction of the cap in the Swiss franc. So we can see that, yeah. Actually, in Hungary, Questor, which was a, I cannot say hedge fund, but a hedge fundish entity, so it was an investment firm, and they went to default after this day. So they were highly affected by increased volatility. Otherwise, also they were cheating with their numbers, as the National Bank realized after this or during this scandal. But yeah, it had its costs. Also here we can see Polish zloty. So emerging currencies have always the tendency to have way more dramatic reactions on shocks. So here we can see that if we have any kind of emerging currencies, then volatility will be way higher than the euro, US dollar, or other developed currencies. If there is no shock, then we can see that, oh, they are behaving like the same, so it doesn't matter. But since this data will be used as an input for option pricing, we will see that, okay, if we would like to secure or hedge our exposure against this exchange rate risk, the problem is that we have to purchase regularly options. If we are not doing these regular purchases, it means that we can see that now the market is starting to become crazy, then we have to do this really fast, otherwise we will purchase options at higher price than we're supposed to. So we start to purchase elevated fees or premiums, and it's bad for business. So when we're doing this pricing, the pricing is really simple because we have a disgusting equation and everything will be calculated by the MATLAB, so you don't have to be afraid of it. We just have to provide the input data, and this is one of the inputs. And one funny part here is that these GARCH models were created, first published, the first version of the GARCH models was published in 1982. Then the second version, which is useful for something, was published in 1988 by Boleslav. The first guy was Engel, and well, people use this, so we can see many articles which started to use it in the early 90s, but mostly it was not appreciated that much. That, okay, you can describe volatility, okay, cool. But when in 1998, long-term capital management went broke because they were not able to withstand the sudden increase in volatility, and they were responsible to half of the option market globally. Then GARCH models started to become much more highly appreciated, so they started to build in themselves in option pricing, in value at risk management, and in all the models when you have to use standard deviation. So now they are everywhere. You can build a diversified portfolio with them, and or you can calculate betas, dynamic betas in CAPM model. So this application is only one way how can we do this. Okay, and still I have 11 minutes, and last thing is to talk about correlation, because correlation is also, since volatility is time variant, then that's why correlation is also changes in time. And last week I tried to show it to you with limited degree of success, because I remember that some data was absolutely not or there were some days when it was not dynamic, so it can happen, but so let's see what is happening. Let's remove this one. We already have the return, and let's analyze the correlation. So let's analyze the correlation between the euro and all these other currencies, because unfortunately we are using currency pairs, so we cannot see the correlation between euro and US dollar because we need the denominating currency, so that's why we can just compare different columns. So let's say that all rows and first and second columns. What do we have here? Okay, so as the last point for today, we can see that currencies have a high tendency to correlate together. Only in the case of shocks, this correlation starts to disappear. So we can see that, yeah, market was not that happy in 2000, and yeah, it was exactly when the Swiss franc upper cap was removed. So we can see that, okay, in Swiss franc it affected the business, but even Euro PLN was dropping a bit, and there were other currencies, this even the Indian rupee was affected. So so we can see that sometimes, and especially small currencies around the Eurozone, they have really strong correlation, so it's always 0.7, 0.8. Except when there are crisis periods, then this correlation disappears temporarily. But even if we are looking on far away currencies like Japanese yen, still we can see that when business is usual, then they have a tendency to walk hand in hand together. In stock markets, we can see only increasing correlation under crisis periods, so this is quite the opposite one, what we can see here. Just we have to be careful that we have to use US dollar denomination or consistent denominations, because until this point AECOM provided us the opposite direction, so the USD was above and other currencies were under, so that's why we had confusing correlation data at the beginning. So yeah, next week we will see that what is happening on corporate level when we are doing all this stuff, and only we will focusing on euro US dollar exchange rate, the rest just for today to show us that what is happening if we are looking outwards for different currencies, and then we will see what kind of hedging strategies are available for us, and which one seems to be more useful for this company. So we will evaluate also these hedging strategies. Okay, do you have any question? Okay, thank you very much for being here, and see you next